Hey, and welcome back to Bollinger Band Essentials Training. We're getting into class number 3, which means we're going to be moving outside of just the basic Bollinger Bands and the indicators associated with it, and we're going to start talking about some of your other traditional analysis tools and some of the techniques that you need to really trade the Bollinger system. And then as we get into class number 4, we'll start to pull together the different methods and the different ways that we can trade the Bollinger system. So in this lesson, here's what we're going to be doing as we look at the additional tools. We're going to talk about candlesticks with Bollinger Bands. We're talking about M and W patterns. We'll talk about setting stops, and we'll have some homework as we move to the end. Let's start off by talking about the candlesticks with the Bollinger Bands. And what you need to understand about candlesticks is they are a very important component in learning how to and effectively trading the Bollinger Bands. What candlesticks do is they represent immediate information on trading sentiment. Now, what is trading sentiment? It's that special word that as technicians we're always looking at, and that is how the people trading the market feel about the stock at that time. Now, candlesticks are great because they give us an immediate feedback into what those people are thinking. And the way we see that feedback, it's not like we're reading a meter, but rather we're reading the price action as it's reflected in that open, high, low, and closing price that we see in those candlesticks there. So it's immediate information. It also is going to give us early turning signals. One of the greatest benefits of your candlesticks is the fact that within 1 or 2 trading sessions, we can see these candlestick formations forming, and those formations are pictures of trading sentiment of the people who are trading that stock. Now, as we look at those early turning signals, what you need to understand is when those signals occur, and specifically when they occur at upper and lower bands, they typically lead to swings in the stock, and that's what you're looking for. When we're looking at the Bollinger Bands and your candlesticks, these two tools work together really close together. One of the misconceptions that people have of candlesticks is they always feel like if it's a reversal pattern in a candlestick, it should be a full trend reversal, and that doesn't always happen. Rather, the candlesticks reflect the swing, the minor level swing of that move and what's going to happen there. Well, that's exactly what the Bollinger Bands encompass really well. And so that's one of the reasons they work together so well. Take a look over here at this picture of 3M. Notice some of the areas that I've highlighted. We've got a perfect little Bollinger squeeze. It started to break. It became a false breakout, and it was highlighted there with a reversal signal from your candlesticks. That happens all the time. You want to know when to identify the false break? Look for the candle pattern. That is going to be your clue right there. Here's another one right here. Right at the bottom of the band, you start to get those candlestick signals. Now look up here as we're pulling away from the band, this upper section where I've drawn the arrow. You're pulling away from the band, and you see these really small candles forming here. It's showing there's a loss of momentum. If you start to combine that with this Bollinger Bandwidth tool and the %B, you're seeing that divergence in there, you recognize that, okay, this trend, this swing is losing its momentum. Even though it's not a specific candle pattern, it's losing its momentum there. Take a look at the green arrow here. Right on the lower band, you get that candlestick formation. Again, right at the upper band, you get the candle formations. These are very powerful, and when you start to see them, you start to pull them together, it gives you really insightful information. So take a look at this Caterpillar trade here. You notice this candle formation at the top, right at the upper portion of the band, right in the middle of the Bollinger squeeze, and boom, you got the bearish trade happening. Then right as you get to the bottom here, there's your little candle formation. It's a Morningstar reversal, and the swing is going the other direction. And you're going to notice at the top and the lower portions of these bands, you're going to get these patterns, and that's where they mean something. That's where they really give you insight into what's happening with the trade. Now, as we start to move into understanding candles with Bollinger, it's really important that we learn how to identify them. We use names so that we can be specific and we can talk intelligently about them. So that's why we name the patterns. But what I really care about is not the names so much as I care about you understanding the sentiment and you understand the outcome from these patterns. So as we get in the next couple of videos, we're going to start learning some patterns. We're going to look at the bullish patterns, then we'll look at the bearish patterns, and we'll pull it all together. Let's start by understanding the bullish formations that we see as they show up inside the Bollinger Bands. And the truth is they're the same patterns you should already be familiar with if you understand candles. But here's how we're going to interpret them. What we're watching for is we're watching for the bullish formations to appear at either a middle band or a lower band. It doesn't really matter if the bullish formations appear at the upper band. At that point, you're already overbought. It's already too late for those formations to really matter very much. with the exception of maybe a rising 3 continuation pattern or maybe a rest after battle. But other than that, the rest of these patterns need to appear at the middle band or at the lower band. And when you see them, it creates a high probability swing setup. In other words, it's a high probability that this trade is going to swing in the next direction, which would be a bullish trade here, because of course they're bullish patterns. Now, where do you get these patterns? Well, you should already know them. These are the patterns that you're familiar with from your Foundations of Stocks and Options and from the rest of the training that you've had here at TradeSmart. If you've not watched those classes, then I would encourage you to do so. But these are really the key patterns right here, and this is what you're looking for. You're going to notice that I've got all 2 candle patterns with the exception of a couple of 3 candle patterns over here. You've got patterns like the bullish engulfing formation, where you have a large white candle that engulfs a small little black spinning top here. Of course, that's preceded by a downward move. That's what this little arrow means. It's a downward move. Then if you move over, you got the tweezer bottom. Tweezer bottom is a powerful pattern here where you've got the matching bottoms here of good-sized candle formations, black moving to white. As candle patterns go with the bullish formations, you're always looking for the black candle moving to the white candle. So look at the color order here, because that's really important. Take a look at the bullish harami. You've got a large black candle with a small little spinning top that's inside. If you're looking at bar patterns, we call that an inside day. Of course, this is a candle formation. We call it a bullish harami. It needs to be preceded from an downward swing from the upward direction there. It's coming from the top down. And then, again, you're looking for this pattern to appear at a middle band or at a lower band. Now, over on the far right here, I've got a pattern. It's not really a pattern at all. I just referred to it as long lower shadows. This is a very important sentiment to recognize. When you see long lower shadows, it could be, especially if you see a bunch of them, let's put it that way. If you see any long lower shadow, it has a lot of bullish sentiment to it. But if you see several of them congregating together, that is a really big deal. The color of the candle bodies actually doesn't matter. It's the lower shadows that's really telling you there's a bunch of buying pressure coming in. If you see that at a middle band, you see that at a lower band, that is a lot of buying pressure coming in, and that's good reason to recognize this as a bullish formation. Coming back to a couple of the 2 candle patterns here, if you look at the bullish counterattack, this is the one that gaps down and trades up and counterattacks at the same close as the previous day. You got your bullish piercing pattern. Again, it's going to gap down and close up inside the previous day. Of course, you got your one white soldier where we gap up and then we close above the previous day's candle body. So those are some more of your solid 2 candle patterns. And then one of the ones that's just as reliable as you can get in the world of Bollinger Bands is your Morningstar reversal. When you see Morningstar reversal patterns at a lower band, you see it at a middle band, the probabilities of this pattern playing out in a bullish swing are really, really high. You need to learn to identify this pattern. The formation here is a good-sized black candle with a small spinning top, that's your star, and then a good-sized white candle. It's a 3-candle pattern here. Now, in a perfect world, the Morningstar reversal is going to gap down, and in a really, really perfect world, it will also gap back up. You don't really have to have it to have the sentiment there, but to have the textbook Morningstar reversal, you need the gap on at least one side there. That's the textbook definition. Again, if you just have the general formation, though, it plays out as a Morningstar reversal almost with a few rare exceptions with great consistency there. And so this is a really powerful pattern to recognize. All of these are solid patterns. You need to learn how to recognize all of them. Even if you don't have the right name, recognize what it is. Now, I encourage you to do some flashcards or do whatever it takes to memorize the names, because it kind of ingrains it a little bit more. Even if it's sitting down with a friend and saying, hey, let me teach you these candle patterns, just so you start to ingrain them more. And going through a trade, going through a stock or a currency pair or whatever, and just looking at the candles and saying, what is this candle pattern? What is this candle pattern? And naming it. As you force it, as you drill that more and more, you'll get more comfortable with it. It will become second nature to you. And that drilling process will be worth its weight in gold when it comes to the real world of actually trading here. So these are your bullish pattern formations. In a second here, let's look at the bearish formations. Now let's talk about the bearish patterns. Now these bearish patterns have just as much significance, but instead of indicating that the trade is going to swing up, instead it indicates that the trade is likely to swing down. These patterns are the inverse image of all the bullish patterns that we just learned in the last video. So here's the principles here. Number one, you're watching for bearish patterns to appear at either the upper band or the middle band. Notice the difference here. With the bullish patterns, we're looking for them to appear at the middle or the lower band, so we have room to swing higher. With the bearish patterns, we're looking for them to appear at the middle or the upper band, so again, we have room for these trades to swing lower here. And when you see them, it leads to a high probability downswing more often than not. So here's the patterns that you're looking for. You want to be watching for the bearish engulfing formation. This is going to be one that approaches from down below. You got a small spinning top, and then of course the engulfing pattern itself. You've got the large black candle that engulfs the small white candle here. The tweezer top, again, it's kind of similar sized candles. In this case, we're alternating from white to black. When you're looking at the 2-day candle patterns, we're alternate for the bearish patterns, we alternate from white to black. For the bullish patterns, we go from black to white. But for the bearish patterns, we go from white to black. That color order there is very important. So look at the tweezer top here. You're going to be trading up near the upper band or the middle band. You got a large white candle and you got a black candle here that basically have the same high price here. Then you look at the bearish Harami. This is a large white candle with a small spinning top inside the preceding day. Again, all these are approached from below. You got the bearish counterattack. This is the one where we gap up and we trade down and we counterattack at the previous day's close. You've got your dark cloud cover. The dark cloud cover is going to gap up and it's going to trade down, moving at least halfway into the preceding day there. You've got the one black crow. This is a really powerful pattern when you see it. Gaps down, closes below the preceding day. These one black crow patterns, the one white soldier, which was part of the bullish patterns there, these are some really, really strong patterns. You need to really identify them. A lot of people miss this pattern in particular. Learn to identify it. It's a very, very powerful pattern, the one black crow. And then, of course, the 3-day pattern here is the evening star reversal. This is just the bearish version of the morning star reversal. The color order here is not that critical. And let me clarify that. The first candle needs to be white. The second candle doesn't matter, and the third candle needs to be black. So the first one's white, the third one's black. The middle candle can really be either one. What matters about the middle candle is that it is a small spinning top. That becomes the star. And again, hopefully, in an ideal world, you'll have a gap on at least one side of that, either the gapping up into the star or gapping out of the star. Either way, it's still going to work like an evening star reversal. It's very, very powerful candle formation here. In a perfect world, though, ideal world, gap on both sides, but at least on one of the sides. That's going to give you the textbook definition. And then the other pattern here is not really a pattern. It's the same thing I did with the bullish formations here. It's the long upper shadows. You see these long upper shadows? When you start to see those at upper bands, you start to see those at middle bands, that is a lot of selling pressure. Be prepared. You start seeing a lot of long upper shadows. Even the candle body really doesn't matter. Even if you have white candle bodies, it still is a lot of bearishness because you have that selling pressure at those band levels, and that's representing some resistance to you. And so you learn these patterns, just like the bullish ones. You start to learn them, and they're really going to take you a long way. Let's look at some examples here. We'll start to pull it together. And I'm just going to take a note here. Look at Google. It doesn't really matter what you look at. You look at any band's pictures here, and you're going to see stuff like this. But look at Google here. There's a little bullish Harami. You get up to the middle band. There's some upper shadows in there. Bearish Haramis, bearish engulfing. Starts to roll back over. Look here. Lower shadows, little spinning tops with lower shadows at the bottom. There's a little bullish engulfing. And, of course, the swing moves over. This is very similar to an evening star reversal. Instead, you kind of had two days in there. You had the gap on the left side and the gap on the right side, but it just kind of took 2 days to develop the star. Look at how it pulls down to the middle band. There's your doji right there in the middle band, like a morning star reversal right there. You see that? You keep going through here. It's like a one black crow, gaps down, closes below. Here's a little bullish engulfing. Every one of these tops has a candle formation, every one of them. And it's really important that you learn to remember your patterns and you learn to identify them when they're happening in the right location. This is a great way to know that that swing is done, a great way to anticipate what's happening with that move here. Notice the spinning tops, a little doji candle up there, bearish candle, that clear sentiment picture here that this trade is reversing. You get back down to the bullish or to the middle band here. You start to have the bullish candles coming in here. You have the little spinning tops. Every one of these little tweezer top there at the middle band, boom, bearishness comes back in. Here's a little bullish counterattack. You know, all these are doing the exact same thing. They're showing that this sentiment is shifting. Let's look at another one. This is just one stock. This is Google. Let's look at Target. Works the same on Target. Watch this here. Bearish engulfing formation. And what happens? The trade starts to reverse here. You get to the middle band, start to provide some support. It actually trades sideways for a little bit. Looky here, long lower shadow at the upper band, or the lower band, I should say. There's a doji candlestick, and the swing starts to move the other direction here. Another little bearish engulfing formation. Right down to the middle band, there's your bullish engulfing. Back up to the upper band, there's your bearish candles coming back in. Back down to the bullish, to the lower band, bullish harami. And you see each one of these turns has some of these candle formations. So just because you have a candle formation doesn't mean you're going to necessarily have a reversal. But when you have them at the right place, the probabilities of that swing changing directions goes up substantially. Let me show you some signals that are often misunderstood. Take for example here, this candle formation I'm drawing right in the middle. Notice how this is a bullish candle followed by a bearish candle here. A lot of people would think, well, see, that's a bearish reversal. But no, look at the location. It's right in the middle of the lower band. It means nothing there. But you take that same formation, you get it up to the middle band or certainly up to the upper band, and now suddenly that starts to take on a lot of bearish sentiment and a lot of bearish weight to it. So you've got to identify the patterns in the right location. That's where they take on the most meaning. And when we start to synthesize it all together, you've got the patterns, you've got your bandwidth, you've got your percent B, all happening inside these bands, and you start to get some really, really powerful signals that in many cases will kind of write your trading script for you when you learn to do the analysis and when you learn to interpret the information that you're seeing there. So as we summarize our candles, you start to see that candles are really important in terms of interpreting the sentiment as it's moving day to day in those Bollingers. If we looked at the 5 steps of trade confirmation, we talked about support and resistance, we talked about identifying the trend. Your Bollingers really help you with that, but you're kind of out here on a desert island if you don't have a way to interpret the immediate day-to-day sentiment. That's where your candles come in. They're a very, very important key to interpreting that information. So here's my summary for you. Candles are a very important component in trading a band system. It's critical to know your patterns and to understand the sentiment that goes with them. Not just understand it, but understand the sentiment that goes with them. And finally, candles will help you get in at the right time, and they'll help you get out at the right time. Very important piece of learning to trade with your Bollinger Bands. Now that we have a good little reminder of what our candlesticks are, let's jump into some pattern recognition and see how they look a little bit different inside the Bollinger Bands. So when we think about patterns, understand that patterns rule. It's long been held that price patterns provide the best setups for trade entries. We've always been looking for these price patterns. They're great to identify those little moments of trading behavior, and then you enter in the breakout on that. Now, one of the challenges of price patterns is the fact that the market is not absolute. The market's relative. That's the great benefit of the Bollinger Bands. Bollinger Bands provide a great structure because they're relative rather than absolute. Now here's what a pattern does. If you go back to our Foundations of Stocks and Options training and you hear my teaching on the purpose of patterns, you're going to remember that patterns, all patterns, are short-term periods of consolidation. Now, those patterns may turn into reversal patterns, they may turn into continuation patterns, but in that moment, it is a period of consolidation. In other words, it's contraction. The trend is no longer moving, it's contracting for that moment. Guess what? That's exactly what Bollinger Bands recognize. They recognize that contraction of momentum. So bands naturally fit into this mold. Now most patterns, this is a distinction you're going to find with Bollinger Bands, most patterns end up looking like M's and W's. Now this is a slight departure from what you've probably learned about patterns before. Typically when we talk about patterns, we talk about terminal patterns, double tops, double bottoms, and whatnot. Those still show up in the Bollinger Bands, but it's different. What you see in the band is usually going to represent an M or a W because the band is really tracking that intermediate level trend. So I'm going to show you this here. They're typically going to look like M's and W's. And then the other thing you need to recognize is percent B. The percent B indicators are a really nice complement to identifying these patterns. So let's talk about M's and W's. M's and W's are smaller variations variations of double tops and double bottoms. They're really just a fractal of the double top and the double bottom. They're very common. We see them all the time. And Bollingers, of course, provide a really good framework to start identifying those M's and the W patterns. Let's look at a couple here. This first example that I've got is a traditional double top. This is a large pattern. You see how it's spread out over several weeks here. It's a terminal pattern. It terminates that preceding trend that was a pretty good sized trend. Now, let's go take a look at an M and W inside the bands and look at the difference here. This is a much smaller pattern. There's a W over here on the left, and then there's an M. They did, in both cases, terminate the preceding move, but it was not a long-term trend necessarily. This was a much smaller level. And a lot of times when you see M's and W's in Bollinger Bands, they're going to be a lot smaller of a move. Just get used to that because it's still a really valuable signal, as you're going to see here. Let's make a couple of distinctions as we talk about the M's and the W's. First of all, M's and W's reflect the end of a swing. And so you're going to start to see these M's and W's, and what was usually a burst of energy, probably coming out of a squeeze, for example, has now turned into a brief moment of contraction or brief moment of consolidation. Now that may lead to another squeeze, but not always. A lot of times it leads to some other formation. That's why it's valuable to recognize them here. So M's and W's help identify the turning points, and very often, of course, they're going to show up with the reversal pattern that we see with the Bollinger Bands as well. Now let me get into a kind of a new divergence of patterns here. I want to introduce you to a guy named Arthur Merrill. Arthur Merrill, back in the 1960s and then with a republishing in the 1980s, identified 16 variations of M patterns and 16 variations of W's. These are not your traditional double tops and double bottoms, but rather they're 5-point patterns inside a move. And there's various ways that they can play out. The idea here is to identify what these little 5-point moves are inside a pattern. So his work has become very popular and famous in technical circles because of the way that it helped to identify patterns. I want to just kind of briefly touch on them here with you. What John Bollinger's identified is he's identified that the bands are a really great way to start recognizing these M and W patterns. And when you pair it up with Merrill's work, it provides a really powerhouse identification of patterns here. So a full understanding is really going to help you. We don't have time in this program to go into a full treatment of the Arthur Merrill work, but this will give you at least a good jump start, and you can see an idea of it here. On the next screen, what you're going to see is you're going to see these 16 M patterns here. Take a look. Let me give you some bullet points here. First of all, there's 16 variations. The M's can combine. This is what I was trying to say. They're not all just double tops and bottoms. They can combine to create more complex patterns. For example, a head and shoulders. It may combine to create part of a three-wave move of a Elliott cycle. But they're just little moves of 5-point swings that Merrill has identified here. Here's the distinction of an M pattern. The distinction is the last leg of an M pattern is a down leg. The last leg is a down leg. And the way he's categorized them is it's a progressive order with M1 representing strongly falling and M16 representing a strongly rising pattern here. So take a look. I'm not going to talk through each of these, but you can just see, if you look at M1, we've got a falling pattern here, and M2 is still falling, but maybe not quite as strongly because the fifth wave here, last move, is not as low. And you can kind of keep identifying this. By the time you get all the way down here to M16, we're in a strongly rising pattern here. M15 similarly. And you can look through these. If you look in kind of the middle here, a lot of these are kind of sideways moves. Some of these actually look like triangles. For example, the M9 pattern starts to look like an expansion there. M10 kind of looks a little bit similar there as well. And so here's the idea that these are just variations of 5-point swings that will show up, and a lot of times you'll be able to identify them very clearly inside the Bollinger Bands. Now, if we flip those, we get the W patterns. Take a look here. There's, again, 16 variations of the W patterns. Again, they can combine to create more complex formations. Here's the distinction. The last leg of a W is an upward leg. And just like the M patterns, the progression is with the W1 representing falling. Take a look at the pattern. It's going downhill here. And the W16 representing a rising move. So if you go all the way to the far right lower corner, W16 represents a rising move. Now, what's the purpose of these patterns? Do you need to memorize them? You probably don't. The truth is, I mean, if we were to sit here and have a quiz, there's no way I would tell you the individual moves. But the idea is to see that there's a lot of variations of these W and these M patterns, and they do show up inside the bands. Let's take a look at a couple setups, and then we'll look at a couple of examples of how they show up here. So the first one I want you to see is the setup for the M pattern is going to be, the ideal setup is a first push that is at or outside the band, and then we get a pullback that is often to the middle band, and the second push falls short. This is very important right here. You see that first push, the pullback, and the second push falls short. What's interesting is the second push isn't necessarily a lower move. It's just lower relatively because the band has gone on to another level there. And so it's important to identify that. This shows weakness in the move, and it very typically turns into a reversal there. Usually marks the end of the swing. Now let's take a look over here, and let me show you what I'm talking about. We were in a nice little trend here. Look at your M pattern here. We're at or slightly beyond the band. The second part of the M does not touch the upper band. And of course, that terminates that swing there. This is a nice little M pattern. Now, the W patterns are going to be very similar. They're just going to be in the opposite orientation here. So, again, the setup is the first push is at or outside the lower band. The bounce often comes to the middle band, and then the second push turns above the lower band. In other words, it can't make it back down to the lower band. Again, this usually marks the end of a swing. These are really valuable patterns to recognize. Take a look here, and I'll show you how this one's set up. So the first push is outside the lower band. The second push comes up here, or I should say the bounce comes up here, almost hits the 20 period, and then it pushes again. And notice we're not getting into the lower band. You see the divergence happening with your percent B. And then watch what happens. We have another move where, again, we're not even close to the lower band. Now, what you have here is you have two W's. This is what I'm talking about with combining them. We've got a W2, and then followed that with a W14. So you really have a head and shoulders, but the head and shoulders itself is not as easy to see as maybe the two W patterns together. But together, all of it does turn into a reversal. So these are very powerful patterns to recognize. And again, you don't need to memorize them all. Just learn to see them inside the band and see this movement. If you can identify, hey, the first push went outside the band, the second one did not, that's what you really need to identify. And again, what I want to show you here, look, just because it didn't make it to the band doesn't mean it was a higher move. This one was a lower move, but still further inside the band. That's great. That's a great signal you get from the bands, is the fact that it's relatively speaking not as low. Even though it was a technically lower low, relatively it's not as lower low. That's one of the great signals we get from the Bollinger Bands here. Now there's another thing I want you to understand about the M and the W patterns. It's kind of almost mystical, but it's really not, and that is their fractal relationship. If you've ever seen me teach anything about Elliott wave or market fractals, you realize that markets move in a fractal relationship, which means there's a picture inside a picture inside a picture, and usually they're pretty similar. They may not always be identical, but they're very similar in formation here. So what often happens with the M patterns is we have a fractal inside a fractal. Let me show you what I'm talking about. One of the reasons M's and W's work is because of fractal theory. They often represent a pattern inside another pattern. And one of the reasons the bands are powerful is because they show the relative nature of the move. Let me show you in practice here. So take a look at this chart of the Dow Jones, and right here in the middle of October 2007, notice there is an M that occurs. Now this is pretty small relative to the overall chart, but if you look at how this plays out, it's exactly what we talked about. A push right to the upper band. The second push fell short of the upper band. Look at your percent B. That is the M pattern that we're talking about. In fact, this is, we can name this is an M14 formation. Now again, I don't care if you call it the right name. If you walk up to me on the street and say, that's an M14, I'm going to look at you and say maybe, or I'll just say probably, not to make you feel bad. I don't know all these things by heart, and I don't think you have to either. You just need to recognize them in function. Now watch what happens here. I'm going to circle this, And watch this. This M pattern is actually the left peak of a larger M. Do you see how that fractal is happening there? Now this M pattern that I've just highlighted here in blue, it's a scale larger. We've gone from a minor level more up to an intermediate type of a M, and now this is actually an M3. So we had on the left peak of the larger M pattern, we had a smaller M. So on the left peak of the M13, we had an M14, and this M13, watch this, this is actually followed by another M pattern, which make up the peaks of a head and shoulders formation. And of course, the head and shoulders could be broken down to 2 M variations. And so if you go to the largest level here, you've got the head and shoulders. Watch this. I'm going to zoom out. There's your head and shoulders in context. And by the way, that was the market top of 2007 moving into the crash of 2008. And so it's interesting that if you keep taking this fractal up, on the smallest level, we had that first M, the ones that we talked about where you say, hey, it's terminating that little short-term move. Turns out that was the left peak of a larger M, which turns out was the head of a big head and shoulders, which turned into a full-on market reversal. That's what I'm talking about when I say fractal relationships. M's and W's very, very often become part of a fractal picture. Usually you can track it for about 3 levels of the fractal, sometimes 4, but usually it's about 3. And when you can see it, you can start to get some really interesting optics for the overall market. Now let's talk about a very key component in understanding a Bollinger Trading System, and that is your stops. It is essential that you learn to trade with stops and you make sure you use them. So here's what you need to understand. As with all systems, setting stops is a must. It is a non-negotiable. The stop is here to help protect your capital. Not all trades are going to do what you want them to do. In fact, the majority of trades sometimes will not do what you want them to do. So you've got to learn to trust your stops, to put them in the right place, and be content when you get stopped out. You know, a lot of times people don't want to use stops because they feel like it's taking money away from them. You know, by nature, it's stop loss. It's a stopping out of the loss of your capital. But what they fail to see is how much more they would have lost if they left the trade going. Now, sometimes, you know, one of the frustrations is, well, I got stopped out and then the trade did exactly what I thought it should have done. And so people start to buy into that story. Well, if I hadn't stopped out, I would have made all this money. That is a really bad trading psychology. You've got to learn how to trust your stops, to set your stops, use them, and just get yourself a good stop system so that you can protect your capital. You can choose any system you like. It really doesn't matter what stop system you use, but not using a stop system is simply not an option. It's a non-negotiable. You've got to use one. So let's talk about some popular techniques here. One popular technique, especially with the Bollinger Band system, is to use a parabolic stop, parabolic SAR. The moving average system is a popular system. A trailing stop is a popular system. I'm not a huge fan of it, but it is a popular system. And then a system known as stair stops is another decently popular system that was kind of popularized back in the 1930s. With the Bollinger Bands, the system I really like with the band trading system itself is parabolic. So I'm going to talk about that here in just a second. I prefer the parabolic, or I prefer a moving average system. Now, whenever I'm not using Bollinger Bands as a system itself for trading, if I'm not using that system, I will lean towards a moving average system for my setting of stops. But inside the Bollinger system, a parabolic type system is really the ideal way, in my opinion, to set the stops. It's very mechanical. It does the math for you. It tells you where to set the stop, and it leaves a lot of the questions out, so you're not having to second guess. So let me show you how the parabolic system works. For those of you who may not be familiar with the parabolic stop system, parabolic SAR, S-A-R, stands for stop and reverse. It's an acronym, parabolic SAR. It was created by a guy named J. Wells Wilder here. And this was his book that he wrote, I should say, in the 1970s, where he revealed his research for the parabolic. What you need to do, this is really simple. I'm not going to go through the details of how you calculate a parabolic. Here's what you need to understand. You simply apply the parabolic SAR to your chart, and then wherever it tells you to set your stop, that's where you set your stop. You don't need a buffer. You don't need any additional components. You just simply say, here's the parabolic. That's where the dot says to set my stop. I'm going to set my stop there. So let's take a look at how this works. Notice the parabolic is always on the opposite side of the trade. So let's just take this chunk right here, and let's say that you had jumped into a bullish trade. Doesn't matter when you got in, but the point is you're in a bullish trade. Each of these little dots, that's where your stop should be. It's always going to be below. If it's a bullish trade, it'll be below your trade. And every day as the trade moves forward, you keep moving your stop higher and higher. And then there's going to come a day where you stop out, as we did here. Now immediately this one flipped back and continued the bullish trade. So your stop keeps staying in here, and you just jump back in, you keep trading it, and you just keep following the parabolic, and you're in this trade all the way through here until right here where it stops you out. And so this is a very, very good system, especially when you combine it with a system like the Bollinger System. In and of itself, the parabolic SAR it's not a great system on its own, but when you combine it with something like what you're learning here with the Bollinger Bands, it's a really, really powerful system. Then, of course, for a bearish trade, it just flips over. Take a look over here on the right side. Once the trade is confirmed bearish, for example, right here, we're pushing into that lower band. Look, the SAR swings back to the top, and it just keeps adjusting, and it's going to accelerate. It moves at what we call an acceleration factor, and it's going to get closer and closer to the price action. And eventually, it will stop out, but it will also give your trade plenty of room to run. It's a very good trading system. I do not subscribe to the idea that you should put all your money into the trade and just let the parabolic get you in and out of the trade. That's a horrible idea. But if you use it as a place to set your stop, and you'll use some of the exit techniques that we'll talk about in the next class, this is a really, really powerful set of tools to have a good trading system at your hand. So that's the parabolic system. Now the other system is the moving average system. This is the one that I teach very heavily in the Foundations of Stocks and Options. It's a system that outside of the bands trading system is a system I tend to gravitate towards myself. Here's how it works. You basically use your moving average, give yourself a little buffer there, and you set your stop below or above the average. Within the band system, the way you apply it is you'll set the stop either over or under the middle band. That's your 20-period moving average. So if you're used to the moving average stop system, as I teach it in the Foundations program, this will seem very natural to you. It's just that we're setting it underneath the middle band, or in the case of a bullish trade, over the middle band in the case of a bearish trade. Now this works great in a trend. There's one challenge: sideways moves. What do you do in a sideways move? Because that middle band, which is a 20-period moving average, will just be moving right through the middle of the stock, and you'll be getting stopped in and out all the time. Well, to compensate for that, if you're in a sideways move, you're going to have to go to the upper band or the lower band. So you either set the stop above the upper band if you're in a bearish trade, or below the lower band if you're in a bullish trade. It's a little more complicated. There's more to think about. That's why I personally think that inside the Bollinger System, a parabolic stop is really the ideal way to just have the computer say, this is where you should set your stop. You can kind of write the trading script, write the blueprint a lot easier that way. But the moving average system is a good way you can also do it. Let's take a look at this target trade here. Notice the squeeze as it's happening here. And as the squeeze breaks out, if you just start setting your stop below that 20 period, which is the middle band, you're going to be in the majority of this trade. It's going to capture about 90% of the trade. You finally would have stopped out right up here, just right in December, and that would have captured the majority of the swing right here. Now, the benefit of the parabolic is you would have actually stayed in a little bit longer and probably gotten stopped out maybe a couple of weeks later. What I really would prefer, I'd really prefer once you see the exit signals that you get out on your own without waiting for the stop. But if you're waiting to get out based on a stop, this is a way you can do that. What I would prefer, as you'll learn in the next class, is I would prefer that once you see this candle formation pulling away from the band, I would much prefer that you just recognize that as the end of the swing. The bandwidth is contracting, you're getting a divergence, you got every other exit signal. Why wait to stop out at a loss or at a down tick? That doesn't make any sense. So when I start to see these signals, I'm out of the trade before the stop. But the stop, this is a great system for adjusting your stop just to protect your capital in the event that the trade goes drastically wrong against you very quickly and you miss the signal somehow. Now, one of the challenges you're going to see with the moving average system is a setup like this right here. Notice how we're constantly above and below the middle band, mostly above it, but constantly above and below it. In a situation like this, the only place to set your stop is below the lower band. And so it really takes a massive move to stop you out. For that reason, I do not gravitate inside a band trading system to the moving average stop. Otherwise, it works really well. But in this particular scenario, I do gravitate towards a parabolic type of a system. It's more mechanical, more mathematical, and I think you'll have better results with it over time. Now, if you'd like to learn some more about trading with stops, I did an entire mastery class on this. It's part of memberships here at TradeSmart. You can just go into your membership area, look up the mastery series, and look for the class called Stop the Madness. That's the name of the class. And if you go watch that class, you can learn more about stops. You can learn more about stop systems. You'll learn more about the parabolic system. Also, I talk in there about the trailing stops and the various ways you can set those. And so that opens up some opportunity. But the key here is when you're trading inside the band system that you do use a stop system of some sort. I don't really care what the system is, but you've got to learn to use a stop system and be prepared to stop out at whatever that risk is that you're setting with that stop.
Okay, in this video, we're going to talk about setting up %B and bandwidth in your Trade Navigator charting software. So let's get over here to Trade Navigator. And we're just going to add this to the current template that we set up before for your Bollinger Bands. So again, we're going to right-click on the chart and go down to Edit Chart Settings. This is the way you do this in Trade Navigator. Right-click, Edit Chart Settings. And when you do that, we're going to come down to the Add button and go down to Add Indicator this time. Not Add Study Pre-Built Pane, but Add Indicator. And we're going to do Add Indicator to New Pane. And this is important, otherwise you will end up with indicators looking funny. So Add Indicator to New Pane. And when you do that, you're going to have the opportunity to add the indicators. Now here, we're going to scroll down a little bit until we find Bollinger Bandwidth. And so there's Bollinger Bandwidth, and just below that's Bollinger %B. And so we'll do the same process for both of these. So let's add Bollinger Bandwidth first. And notice here that we've got the opportunity to set the settings. This one is not tied in with the linked input, so we're going to go ahead and set that setting to 20 and 2. Those are the settings that we're using for the bands, and you want your bandwidth setting to be the same as the band setting. So 20 and 2. Now, if we want to go add the next one here, we'll click on Add Indicator to New Pane. Just do the exact same process, and we're going to scroll down to Bollinger %B. There it is. Hit Add, and again, let's clarify these settings. Let's change it to 20 and 2. Now, what I like to do is I like to change the colors around. I like to make these so that they're not all blue or all purple or whatever. So what I like to do here, we'll just do this for %B. We'll come up to the top here and we'll click on the color. And, you know, I really don't care what the color is, just something different to distinguish it a little bit here. And there you have it. So that's how you set these up. Now, one thing I like to do to the %B, in different charting softwares, it shows up different ways. But here in Trade Navigator, you can see that there's really no specification whenever you're extremely overbought or not. And so what I like to do is I like to add a horizontal line. So the way you do that here, we're going to click on the pane for pane number 9, %B. We're going to go Add again. This time we're going to do Add Horizontal Line to Selected Pane. Now we're going to need to add 2 of these. So one of these is going to have a value of 100. And one of these is going to have a value of 0. So we're just going to do 2 of these in here. One at 100 and one at 0. And then what that does is it gives you some clarification when you're actually overbought. I like that. I'm also going to make this line a little bit deeper. So instead of having a dotted line, I'm going to make it a thin line, but at least it's a solid line. And, you know, you can change the color of the line too if you want to. You can make it black or anything else that you choose to make it here. Let's do something kind of about like that right there. And so I'm going to change these in here, make it a medium line, and then we're going to hit OK. And when we do that, now you can see, okay, great. I am clearly above that 100 level, or I'm below that 0 level. And now you can tell specifically where you are in relationship here. Just to clarify, the 100 in Trade Navigator, 100 is the same as 1.0. and 0, of course, is 0. So 0.5 is equal to 50. That's just the way the scaling works in here. But you can look here, and you can see what we just talked about, and you can see, okay, great, I'm overbought, and I'm outside of the band. Perfect. It's working the way it should. I'm below the band here, and I'm oversold. So that's exactly what you're expecting to see. So there's your bandwidth and your percent B indicators here in Trade Navigator. Now, the next thing you're going to want to do is add that to your template. So do you remember how to do that? We're going to come up here to Templates, click on Template, and when you click on Template, you go down to Manage Chart Template. And in this case, what we're going to do is we'll click on JWBB, and we will save to. Save current chart settings as JWBB. The answer is yes, save it. And now, guess what? You can click off of that. When you push hotkey number 1, template number 1, voila, there's everything, the full suite of Bollinger Band templates. The Bollinger Bands, of course, on top, Bollinger Bandwidth, and then the percent B. All right, so that's how you set it up here in Trade Navigator. Okay, in this video, we're going to talk about how you set up the percent B and the bandwidth in MotiveWave. Again, if you're using a different charting software, this video will not be overly helpful for you. But if you're using MotiveWave, it will show you exactly how to set it up in MotiveWave. So we're going to come over to the MotiveWave charting application. If you're not already on your Bollinger Band template, we want to pull that up. I'm on the default template right now. So let's go over to the File menu and go down to Chart, Template, and then over to B-Band Suite. Now, alternatively, you can use the key command Option 7. That's the one we assigned to this one, and you could do that one. But we're just going to click on it, and there is our template. Now, what we want to do is we want to add the study. So let's go back up to the upper left corner, click on the Study menu. We're going to go down to General, and then we're going to come over to Bollinger Band percent B. Now, you notice both of these two indicators we want to add are right next to each other, Bollinger Band percent B and Bollinger Bandwidth. So let's just click on the percent B, and it will bring up this window right here. And when you see this, you're going to notice that the bars is already set at 20 and the standard deviation at 2. That's the setting that we want to use for this percent B right here. Now, if you want to change some other distinctions, you want to change the line color, you can do that here. You can also change the top fill and the bottom fill. These top fills and bottom fills are going to show up when the percent B is overbought or oversold. I'm going to change the line to a little bit of a thickness here. You know, I put it about 1.5, 1.5, or 2. That typically works pretty well. And then I'm going to hit Create, and there it is across the bottom of our screen. Now, if you want to make that a little bit taller, if your screen's a little big, you can click on the black line and just drag it right up and rescale that just a little bit. Now, what we need to do is we need to go add the Bollinger Bandwidth. So again, we're going to come to the Study menu, and we'll go down to General. And then we're going to come over to Bollinger Bandwidth. And when we click that, you'll get this menu. And again, the inputs are already predefined at 20 and 2. Those are the settings we're going to use. So we don't need to change that. If you wanted to, you could click on it and change it, but we don't need to. For the line, I don't particularly like a black indicator line here. I like a little bit of color. So let's maybe make it, well, fuchsia's a little over the top, maybe do burgundy or something. And then I like to get a little bit of a thicker line. The fatness of the line doesn't really matter, but you know, I like to have it. And then one distinction that we can do, you could just plot it like that if you want to, but if you look at the little pencil just next to the line right here, click that, and you've got a few more distinctions you could make in here, one of which says shade type. You see the shade type? If you click that, I like to add this in here. You don't have to. I think it looks nice, though. I do the below, and then when you put it in here, you've got a little shading in there with your Bollinger Bandwidth. Now, again, that is not necessarily, you don't have to have that, but I kind of like the way it looks, and you can rescale these to make them look however you want them to look on your screen. And that's how you set that up in MotiveWave. Now, if you want to save that to a template, it's really easy. We're going to come over to the File menu, go down to Chart, and we're going to go to Template, and we're going to go Save as Template. Now, watch this. We've already got this one saved, so we'll just click on B-Band Suite for Bollinger Band Suite and click Save As, and it's going to say, do you want to overwrite this? You're going to say yes, and boom, it's done. Now if we click on our key command option 7 again, because that's the one we assigned it to, there are your Bollinger Bands as well as your %B and your bandwidth across the bottom. And that's how you set this thing up in Motive Wave.
That brings us to the end of class number 3. So here you've learned about candlesticks, you've learned about some patterns inside the Bollinger Bands, and of course you've talked about the stops. Now it's time to talk about homework. What should you do? Well, here's what you should do. Go look at several charts, look for M's and W's, see if you can find some of these patterns. Also, practice identifying your candles, extremes inside the bands. Go look, where are the candles happening? Right at that upper band. That's right inside that band system. Where is the candle pattern happening? What's happening after that? Look for it at the lower band. Look for it in the middle band. Practice identifying your candles inside the band system. You're going to get a lot better at it, and it's going to really pay off. It's a practice that's worth your time. And then finally, watch the follow-through and see how the trades play out based on the candles that you interpreted. It's really important that you come back and look at that. Now, the way I prefer to do it, if I'm testing something like this, if I'm trying to really practice it, use your back trading tool inside your charting software. In Trade Navigator, it's called Historical Replay. In Motive Wave, I think they call it Replay Chart. I kind of forget the name, but it's Replay something another. Different charting systems call it something different, but the idea is it's back trading. You're going back in time and you're replaying the history day by day. If your charting software doesn't have that feature, you can still usually scroll back in time and just push the chart forward manually day by day, and it's kind of a simulated historical playback. That doesn't work really well when you're trying to switch templates, but if you've got everything in one template like we can do with the Bollingers here, that's a great way to do it. And you don't even have to have a more expensive charting software to get that practice in. So I encourage you to do that before the next class. That will help lock in some of this information. And in the next class, we're going to start pulling all these different elements together into the Bollinger Band trading systems.